So we've just started Q3 of 2023. We've ended June, and so we've got the first half of the year sort of in the data set, and it's approximately fixed. So let's see how it looked for Las Vegas real estate during the first half of 2023. I am Justin Miller with the Chong Miller Group. At the Chong Miller Group, we help people buy and sell homes. We help people build wealth through real estate. All right, so this video, single family resale residential in the Las Vegas Valley. So let's go ahead and take a look at what happened in the month of June. Remember, this is the July video, so we look backwards 1 month. We look at the full data from the month of June, and we make comparisons month over month. So June 2023 compared to May of 2023, and also year over year, so June 2023 looking back to June of 2022. Now, before I get into the data, you will remember I've said multiple times over the course of this past year that year-over-year comparisons were looking bad in the first half of the year because of the strength that we saw in the first half of 2022, and that year-over-year comparisons starting in June would start to sort of flip that script, and we'd start to see year-over-year comparisons that go from looking pretty decent to looking really great by the end of 2023. So we've flipped that now, and most of these annual comparisons then are going to start looking really much better. Again, though, just because they're looking better does not mean they're any more accurate. We're looking across a 1 year period of time on these annual comparisons to a year that itself was just incredibly strange. So I do want to caution you about that. But it's going to become harder for those people who've been really bleak on the market to be saying really bleak comparative information, because that comparative information is going to start shifting in ways that for prices, for sales, for pending contracts, things like that, start to look really favorable. Nonetheless, there have been a lot of commentators out there who are still so enmeshed in this extreme negativity, everything's crashing. There are actually some out there now saying they found the magic answer as to why things had not yet crashed, but they're about to. These people are never going to be satisfied because they're not actually trying to tell you what's going on in the marketplace. They're just trying to get views from people who like looking at traffic accidents and plane crashes and other bleak things. The real information is the information I have here. It's pulled out of the multiple listing service. I pull it out every month on the 7th. Now, one note of caution, last month, June of 2023, was the absolute busiest month that the Chong Miller Group has had since we got into real estate. So that was very taxing on me. I ended up not being able to put out my multifamily update video. I also had to pull the data a little early in May. I pulled the data on the 5th, where normally I try to pull that data every month on the 7th. That way I've got the best, more stable comparative information. So this data was pulled on July 7th, and I'm recording this video on that date. So how do I know that the people who are coming out with really negative, bleak commentary, telling you to beware, get out now, etc., everything's crashing? Because one of the latest things that those people have started talking about has been foreclosures, and how bank-owned property, REO property, flooding back into the market, going to be driving down prices. So I looked for that information for you. And I'm not going to give you a long comparative set of information. I'm just going to tell you in the month of June 2023 in the Las Vegas Valley, there were a couple of foreclosure sales. So how many foreclosure sales were there? In June 2023 in the Las Vegas Valley, there were 16 foreclosure sales. Now, that number is actually elevated from last year, but that number is still so small. It doesn't matter if it's elevated, if it's doubled, if it's tripled. It just doesn't matter. It's a very minuscule part of the overall market. The number of foreclosed properties that are coming into this market for sale, they're not tipping the scales at all with regard to total number of transactions, with regard to price of those transactions. These people who are talking about foreclosures, bank-owned property, distressed debt, the collapsing of Airbnb and other short-term rental, and etc., they're coming up with a lot of excuses for you to be scared about. But they're nothing except headline-grabbing, clickbait type issues. They're not real. They're just plain not real. So let's talk about what did happen in Las Vegas in June of 2023. Now, the first thing, kind of interesting, is the price. How did pricing do? Well, pricing was actually flat from May to June. Pricing was at $440,000. That's at the median. So median sale price for a resale single family home in Las Vegas, $440,000. Now, some of you might be thinking to yourself, but Justin, you'd been suggesting prices would go up. Well, in some manner, prices did go up. And I want to talk about that just for a second here to make sure it's understandable. People tend not to buy houses for cash. They tend to buy those houses on a mortgage. And so a couple things influence what mortgage payments are. One, the overall price of the house. Another thing that influences the mortgage payment is how much money somebody puts down. In other words, the size of the mortgage they're taking. So you could take, you could put down $44,000 and take out a 90% loan to value loan. You could put down $88,000 and take out an 80% loan to value loan. Well, that 80% loan to value loan is going to have smaller payments. Also, the interest rate. So I want you to think about this. A house goes into the market ready for sale. It does not close instantaneously with a new buyer. Rather, what happens is it goes onto the market, people come and look at it, somebody makes an offer, negotiation takes place, and a pending contract is issued. That pending contract then takes, on average, just about 30 days to work through the system. Sometimes it might be 21 days, sometimes it might be 45 days. That's sort of the overwhelming majority, or between 21 and 45 days. Some will even be a little bit longer. It's almost impossible to do transactions at less than 21 days, especially in a property that sits in a homeowner association. But if it's all cash, non-HOA, could possibly do the transaction in 10 days. It's almost impossible to do it more quickly than that. So we have this period of time during which the contract is pending. The property is in escrow. So we list on one date, we get into contract on another date. We go through the escrow process, that pending contract time, before we hit closing, assuming that the transaction is successful. Well, that total period of time may look a lot like 60 days, right? If we're in contract for 30 days, but we were on the market for 30 days prior to that contract, that's a 60-day period. So if we think about closings that took place in June, those closings probably went into contract in May, which means those properties probably went onto the market in April. And so what happens is we see pricing, when we look at this data, that yes, it's current. It's telling us what actually took place in the market just a couple weeks ago. But it's telling us actually about transactions that went into contract about a month prior to that. And so price gets set at the time of the contract. It may be renegotiated a little bit, but that renegotiation would be down and only under some circumstances. So if you think back to what happened in May, we saw interest rates spiking higher. They had gone from about 6.3% at the beginning of May to about 6.9% at the end of May. That was causing those monthly payments for anyone putting a house into contract in May, likely to close in June. Those monthly payments were going higher. So that we were able to maintain the same pace same price in June relative to May meant that even though interest rates had gone higher when those properties were going into contract, and therefore payments were going higher for the individual buyers, we were still holding the line on price. So that's actually really good news. So if you're thinking from a buyer perspective, prices did go up a bit. If you're thinking from a seller perspective, it's true. You were not being able to sell your property in June for more than you could sell your property in May. So the market was very flat in that regard. And that's fine. We don't need to have 3.6% price appreciation every month. And if we did, it'd actually be a pretty unhealthy market because we'd be pricing people out of the market left and right. So pricing on a median was flat. June of 2023, looking back at May of 2023. What about year over year? So you'll remember we peaked for price in May of 2022. We came down 2250 in June of last year before we started coming down more significantly. So June of 2023, $477,750. We are down 7.9% from that. So from the peak to the trough, we'd come down about 12.5% for single family homes. We're now down only 7.9% for single family homes resales. So that's actually really encouraging news, and that's because we've been going up in price since February. And now, of course, the comparison is coming down because last year's numbers are, they're in the book, they're fixed. Every month from now on, those prices from last year on that annual comparison will be coming down. All right. Now, I also look at price per foot. How did price per foot do? And this is kind of interesting. You may remember from the video last month, April and May, price per foot were perfectly flat. And that suggested something about the internal dynamics of the pricing market, that the upper end of the market, the lower end of the market were relatively lightly traded, and a lot of activity took place right in the middle of the market. Well, now we have a little bit of divergence from that. We actually saw price per foot come up to $241, or $5 more than it had been in May. That's up 2.1%. Where median price was exactly flat, the average price per foot came up 2.1%. That suggests we're seeing some more strength rematerializing into the market at the higher end of the market. Now, it's not suggesting anything weak in the middle of the market, but it does suggest the higher end is starting to show a little bit of strength. And so that's good news because we want to see the market being pulled in one direction or another. Now, we are down 8.4% from 263 per foot in June of 2022. So that's kind of interesting. So we came up, we came down 7.9% on the median and 8.4% on price per foot, which means, again, we're seeing relatively better strength in the middle of the market than we were seeing this time last year as the market was sort of peaking in this last cycle. But now we're starting to see prices come up a little bit more on a per foot basis, suggesting higher end properties are starting to sell a little bit more favorably than what they had been doing in April and in May. Okay, all that's good, important pricing information, but what about the number of transactions? Because that tells us something about demand, because you don't get a sales transaction without a buyer. So 2,085 single family resales closed, meaning they finished the escrow process and a new buyer owned the property, 2,085 in June of 2023. Now it's down slightly. It's down 2.1% from 2,130 that closed in May. That's a small decrease that probably has no actual information in it and may simply be related to some transactions taking a little bit longer. We'll look a little bit more at that issue as we get to the end of the video, but I think that 2.1% decline is just simply noise in the data. We are down 19.7% from the 2586 that closed in June of last year. And again, that actually is, while it's a drop, remember we're comparing to that unusual year of last year, and this is a smaller drop compared to that annual number than what we've been seeing. So this is actually a tightening of the market. And one other note I'll just make, we are about 1,000 transactions per month higher than what we were at the beginning of 2023. So it suggests a real strengthening in the market and a lot of demand having come back in, even as interest rates have been hanging out in that sort of 6.7 to 6.9% range, which is not super high, but we definitely saw last year, once interest rates went above 6.5%, that's when demand really started dropping out of the market. We seem to be accommodating interest rates that are above 6.5 even, but once we get to that 6.7, we're starting to see that resistance in the market at this time. But what about pending home sales, right? We've got closed. That tells us how many actually owner traded hands. But pending contract still tells us what demand looks like out there, because those are properties going into contract, waiting to close escrow. So most of those will close escrow in July. They're going into contract now. They're going into contract now while interest rates are actually, they're averaging about they're averaging about 6.72% over this past couple weeks of the month of June. So they're high, but they're not terribly bad. If we start seeing interest rates back up above 7%, then we have another problem. And now I've been saying that I think that mortgage interest rates actually could come down a little bit, even if the Federal Reserve continues to increase the Fed funds rate, the policy rate. Most of the members of the Fed have been talking aggressively again, that after they took their pause in May, that they'd like to start increasing interest rates again. But they're also talking, they probably have 2, maybe 3 quarter point increases remaining in front of them before the end of this year, or before that rate increase regime comes to an end. Now, the Fed funds rate is not directly tied to the mortgage rate. So Fed funds rate can go up and mortgage rates could actually go down. We've seen divergence, and I've talked multiple times that the mortgage interest rate, the 30-year fixed rate loan rate, tends to be just less than 2% higher than the 10-year Treasury. Well, the 10-year Treasury is a Treasury bond. It's a note issued by the U.S. government for 10 years. We also have 2-year bonds. We have 5-year bonds. We have 30-year bonds, etc. So the government issues debt in different durations. And I want to talk about this just for a second, because the Fed funds rate, that's an overnight rate. That's how much the Fed charges member banks if there's borrowing that needs to be done overnight. So that's a one-day rate. The Federal Reserve has pushed the Fed funds rate all the way to a range of 5.0 to 5.25%. Let's say it's 5.25%. That means that a bank could borrow money for one day at 5.25%. Now, that's the only rate that the Fed actually controls. Other interest rates are set in the bond market, bond buyers, bond sellers. Now, kind of interestingly, the 2-year bond, 2-year Treasury, this past week went to 5.105%. Now, that's interesting because that's actually less than the overnight Fed funds rate, which is that range up to 5.25. So you could borrow for one night at 5.25, but you could actually borrow for 2 years and pay a lower interest rate at 5.105. That's referred to as an inverted yield curve, where shorter term interest rates are higher than longer term interest rates. Now, to look at the inverted yield curve, we normally compare 2-year and 10-year. So the 10-year The same day this happened, which was just a couple days ago, the 10-year jumped. The interest rate on it jumped all the way to 4.057%. So think about that for a second. Overnight, 5.25, 2 years, you could borrow money if you were, able to, if you were the U.S. government, at 5.107%. So that's less than the overnight rate. The 10-year rate, 4.054%, considerably less than the 2-year rate, and the 30-year bond, 3.992%. That means the entire yield curve from overnight to 30 years is inverted. Interest rates are are higher on the short end than they are on the long end. It's a relatively unusual condition. It's a condition that precedes recessions with a pretty accurate assessment. Now, the 10 to 2-year Treasury yield curve has been inverted for approximately a year. So the longer that stays inverted, the stronger the signal for a recession. But to see the entire yield curve inverted literally from a single day to 30 years is really unusual and suggests we're approaching a recession. Now, we've not seen the recession yet. We've not seen big increases in unemployment. In fact, the unemployment numbers for June were released this morning, and they show that the unemployment rate actually dropped from 3.7% to 3.6%. They show that the number of job gains were about 222,000 this past month, right? Unemployment increasing would mean we'd see job losses. We're not seeing job losses. We have seen a slowing in job gains. But we've also seen a slowing in the manufacturing numbers. We've seen a slowing in import numbers. We've seen slowings in different parts of the economy, such as high tech, for example, such as banking, for example, and such as definitely real estate, for example, where we've seen downtrends or at least slowings of activity. Strongly suggestive of we'll be going into a recession within the next 6 months, probably within the next 4 months. So by the end of the third quarter, I'd be looking for recession. Now, as it relates to housing prices, recessions and housing prices are really not correlated. Numerically, statistically. So if there is a correlation, housing prices go up slightly in times of recession. So it's a negative correlation. Housing prices go up while the economy is losing jobs and slowing down. But it's a weak correlation. So I wouldn't count on that bringing you benefits. I wouldn't count on that bringing you detriments. We'll see what transpires with regard to recession, but it's going to have zero or negligible impact on the housing market. I mention it to you only because we do find ourselves in this situation where not only is the yield curve inverted, but if we take that 4.0% 10-year bond rate and we attach 2% on top of it, 196 basis points statistically, but let's say 200 basis points. On top of it, that takes us to what should be the mortgage rate for 30-year fixed rate loans, 6.0%. So the mortgage rate is actually elevated above where it statistically should be. We're about 75 basis points too high, which means that the mortgage interest rate could still very well come down to that 6.0, 6.1% kind of range. And that would certainly be beneficial to the housing market. That would increase activity and allow for increasing prices in ways that we're sitting in this more restrictive area right now is interfering in some sales. And remember then, when people sign contracts, they're signing contracts based on the current conditions. They're looking around, they're seeing what's available, but they're seeing what the interest rates are for the loans they may have to take out, things like that. So if we look at pending contracts, that's really interesting and it's encouraging information. 2,072 pending contracts written on single-family resale homes in Las Vegas Valley in June of 2022. That's up. It's up 1.5%. Not a whole lot, but it's actually up from the 2,041 contracts that were written in May. That shows still buyer growth. Buyers are coming into this market wanting to buy, even at those higher interest rates. We are also up 5.1% from the 1,972 pending contracts that were opened in June of 2022. So kind of an interesting thing there is we've seen actually for multiple months the pending numbers going up significantly, even while we've seen sales going up, but dropping a little, going back up, dropping a little. So that suggests while there may be some difficulty getting things through contract, there's lots of buyers out there wanting to put things into contract. That's strong demand. And I think that that's really the story of what this market is strong demand. Well, what about supply? How strong is supply? That's a different story. There were, at the end of June of 2023, 3,702 single-family homes listed for sale in the Las Vegas Valley. That is down 12.5% from the 4,233 that were listed for sale at the end of May. This is a continuation of 7 months of strong downtrend in the single-family home space. There's actually a little bit of a downtrend an additional month prior to that. So 7 months of just plummeting demand. That means that suppliers are not in this market in large numbers. And that's actually a problem. It's creating upward pricing pressure. It's also creating problems that buyers are not finding as much as they would like to look at. And maybe not finding at all what they actually want to buy, and therefore they have to wait in the market for something to come back in. Now we're also down on inventory by 47.2% from the 7,008 that existed on the market in June of 2022. That's a really big drop. We've dropped almost half that inventory. In fact, from the peak inventory that we saw in September of last year, we are down 61.9% from that. Last year, we almost made it to 10,000 units for sale, which is about average, about normal for the marketplace. We are at 1/3 of that. We're at 3,700 housing units, single family housing units for sale, listed for sale, sitting in inventory in the valley. That's really, really small. In fact, that's interesting because there literally have only been 3 months that had lower inventory in the Las Vegas Valley in the past quarter century. And 2 of those months happened to be last year and 1 was the year before. So we're looking at lower inventory than what we saw throughout 2021. Now, of course, sales are lower than 2021, and that's partly because interest rates are higher. So we're not getting that same pushing higher on prices right now, but that's coming, right? We will see prices going higher, especially if we see any kind of drop off in interest rates. Now, what about new listings, right? Newly listed into the market, that replenishes our inventory. And so we like to see new inventory come in. Sellers actually listing their homes for sale so that buyers can buy them. 2,446 newly listed resale homes came into the market last month. And that's down from 2,541, or down 3.7% from what we saw in May. Now, I had suggested, I believed 6 months ago, that we would see some increase in new listing levels in May and June of this year, where normally March and April are the strongest. We actually saw new listings for houses coming down in March and April. Well, May was a disappointment. June has been a disappointment. And so inventory just keeps going lower and lower. I don't want to say it's crashing because that's not exactly right. And I don't want to use that word. The market is functioning. It's just that we've got a dearth of sellers. There's what in the stock market might be called a seller's strike. We don't have enough sellers. If you've got a home that you are thinking about selling, please talk to me. We need more sellers. And I would be glad to help you figure out how we actually do this. And by the way, this low inventory problem, this is structural. There are three real reasons. I mentioned last month, I hope to do a video on this soon, that talk about why inventory is so low. Two of the three reasons are structural. The other one is related to transitory issues with interest rates. And that could go away if we see interest rates coming down. But the other two reasons, they're constraining inventory in ways that we're going to be living with for a really long time. Now, new listings also down 48.7% from the 4,769 that we saw in June of 2022. And this, again, this is where I say those annual comparisons are going to start to flip, where we had seen significant drop-offs in the first part of 2023 for prices and for number of units sold and for contracts being written. Now we're not seeing big drops there. What we're seeing now are big drops in new listings and inventory. And we're seeing smaller drops, and we'll start to see increases in those annual comparisons on the demand side of the equation. So, but the supply side, it's being hit hard right now, relatively certainly to what it was in 2022, but it's being hit hard actually in terms of any kind of normal market. Now, I do normally also give you one additional piece of information, and that is back on market. These are failed contracts, 762 pending contracts or escrows collapsed in June. That was 26.7% of the contracts that existed in June, down slightly from the 27.8% that collapsed in May. Remember, though, these are numbers that are still double what would be normal in a healthy market, where we'd be looking at 10 to 15% of contracts failing. We're looking at just shy of 30. We're looking at a quarter of the market, 26.7%. Appraisals, again, becoming problematic. And I talked about that some last month. I will certainly continue to talk about it. I've got some new information about some of the issues behind appraisals, but I don't have time to put that into this video right now. So I want to try and do a different video on that. And that is, that's the information for the month of June for single family resale in the Las Vegas Valley. Again, I am Justin Miller with the Chong Miller Group. At the Chong Miller Group, we help people build wealth through real estate. We help people buy and sell homes. If you're a buyer and you're thinking about buying in this market, you need an agent who understands how to transact, how to get into contract and hold those contracts together in a market with very low inventory. And if you're a seller, please also reach out. We need property to sell in the valley. But at the same time, that property needs to be priced right. If it's not, things are languishing on the market. It's not everything that's selling. Things have to be priced right. You have to position your property properly. And we've been really good at doing that. So please reach out to us. I'd love to talk with you, see how we can help you with your real estate adventures. I'll see you in the next video. Thank you.